Dear students, today we are going to talk about Introduction to Financial Accounting. This topic is part of Accounting for Management with course code 104 in the first semester of your MBA program. I am Dr. Ravi Thati. I am associated with Kim School of Healthcare Management. Now, let's look into what is financial accounting. When you look at the definition, there is a process you can see. We know that finance is the lifeblood of the business. Financial accounting is your making the records of the transactions of finance accountable. For that, you need to record, you need to process, you need to interpret. Now, let us look at the famous definition of financial accounting. Financial accounting is the process of recording, classifying, analyzing, summarizing and reporting myriad of transactions resulting from business operations. Now, what for you do all these things? Let us say the board of directors of the company, if they want to understand the financial statements, they will not understand the technicalities of the financial accounting like debit, credit, the expenses and incomes, varieties of expenses. Let's say if a company like Genpact has to present all the financial data before the board of directors, it runs into thousands of pages. So, the board of directors don't have that much time. So, therefore, they want the crisp of what has happened in the entire year. So, what is that? Let us say it is grouped into two categories. One is the performance of the company and the position of the company. Now, to know the performance of the company, we take the summary of the expenses and summary of the incomes. Take the difference, you call it net result, and that result can be positive or negative. The positive is known as profit, the negative balance is loss. So, the net result of business operations are, we are deriving it from the financial accounting. Now, position also is understood. Now, the position of company, financial position of the company. How do you understand the financial position of the company? The position is understood in two ways again. What is the position of the stake in the assets of the company and what are the assets? The stake for the assets of the company, let us say equity shares, preference shares, the debentures, bonds, or in one word, all the debt, current and long term debt. Now, likewise, you have the assets, fixed assets and current assets. So, what are the assets that you have and who are the people who have stake in those assets? So, the position of the company, financial position of the company. Now, let us come back to the definition. Accounting is the process of recording, analyzing, classifying, analyzing, summarizing and interpreting the financial results and also presenting the financial position. The financial results we see from the profit and loss account, or we can also call it income statement. And the balance sheet presents the financial position of the business organization. Now, what is the purpose of preparing these financial information? Now, this is to meet the requirements of the external stakeholders and the internal stakeholders. Like you have creditors, you have regulators, you have tax authorities. Now, financial reporting standards, generally we use GAAP, generally accepted accounting principles. Now, there are common GAAP principles in the United States and in India. So, if it is principles related to the United States of America, then you call it US GAAP. Then, if those principles are modified and adopted according to the requirement of the Indian perspective, then you call them as Indian GAAP. Now, apart from Indian GAAP and US GAAP, you have international. These international generally accepted accounting principles, international GAAP, are universal across the globe, across the world, irrespective of the nationality. So, you have US GAAP, some countries follow US GAAP, you have Indian GAAP, some of the South Asian and Southeast Asian economies follow the Indian GAAP. We have international financial reporting standards applying these generally accepted accounting principles. Now, what's the difference between the international GAAP and the Indian GAAP? What's the difference between US GAAP and the Indian GAAP? Now, the difference is the recognition of the revenue and valuation of inventory. Because of the valuation of inventory, a particular type of inventory valuation results in a different profit when the data may be same, but because you are treating inventory in a different way compared to the Indian way of treating the inventory. Now, inventory is nothing but stock. We call it stock. So, due to the treatment of the inventory, there may be a difference in the profits presented by both Indian firm and the US firm. The data may be same. The way we prepare the financial statements are different because you are valuing the inventory or stock differently. Also, revenue recognition. Now, I'll present to you revenue recognition. There is some assumption where once the amount is becoming due to be received, then you recognize that the revenue is earned. And some other assumptions say unless you receive cash, as long as you don't receive, you cannot account it for. So, there are two perspectives. So, because of this treatment of revenue by two parties differently, there may be different profits arrived though the data is same. So, what we understand is there are different financial standards across the globe, and we also try to incorporate the Indian perspective. Though we adopt the international GAAP, we try to apply Indian perspective and try to synchronize, we try to map against the international standards. Now, let us look at the objectives of financial management. Now, when you look at the objectives of financial management, what is the purpose for which the financial accounting reports or records are prepared? Now, one is to maintain the transparency. To maintain the transparency, the financial statements are prepared in such a way that they are clear and legible, understandable. Every stakeholder, what we have listed earlier, be it management, be it regulator, be it tax authorities, be it shareholders, employees or researchers, anybody who goes through your financial records should be able to understand, and you are maintaining transparency in the sense you are presenting them in a crystal clear format. When you are looking at the financial statements, they should follow consistency. What is that? Let's say that I would present before you two methods of depreciating a fixed asset. If fixed asset is depreciated with a method called straight line method, and the same method should be followed in all the years. For some years you cannot follow straight line method, and for some years you cannot follow diminishing balancing method of depreciation. So, there should, if you are adopting a method, and that method should be consistently continued without changing in between. Now, there may be a situation where the tax authorities, the government agencies may be imposing on us to change it. In that case, you had to provide a proper justification of why you are changing the method of depreciation or calculating the method of depreciation. Now, another objective is comparable. You had to prepare the financial statements in such a way that they are comparable. Now, in 1 year, you are preparing the financial statements in millions of dollars, and in another year, you are presenting in crores of rupees. So, it is not comparable. In one financial year, you are using dollars. In another financial year, you are using rupees. So, this is not comparable. You cannot compare previous income statement, previous year's income statement with the present year's income statement. When you are presenting the financial statements, they should be comparable. And most importantly, it should be reliable. Provide accurate and verifiable financial information. What is that? Whatever you record in the books of account, let it be backed, evidenced by a voucher or a small slip or a small note. You cannot simply write down just because there is a deficiency in particular area. You cannot write down the accounting figures. You had to validate it. Every entry that is made in the books of account should be validated, backed by an evidence or supporting bill or document. Now, all the people who are preparing the accounting data should understand that whoever is putting their signature on this financial data, it may be the middle level management or the top level management, it may be the company secretary, it may be the chief finance officer, it may be the board of directors who will be the signatories for the annual report and the financial statements of the organization. But one should understand, one who is in charge of the accounting process must understand that each one of them are accountable. Some time back, there was a problem in the financial information provided by a noted company. And because of the misappropriation, the chief finance officer, the CFO, without taking the name, was called to the court to present what exactly happened. So, everybody who is in charge of the accounting books should make it in such a way that they are accountable. Now, legal compliance, you had to comply, you had to comply these standards, the laws of the land and regulations of the nation. For example, in India, we have Ministry of Corporate Affairs, we have SEBI, Securities Exchange Board of India, and there are respective registrars of the company, at regional level, at state level. Fine. So, when you are preparing the accounting documents, you should prepare in such a way that you are complying to the, the notes, the sections notified from time to time by those regulators of the country. Now, who are the parties interested in what we are preparing? There are investors, there are creditors, there's management, there are regulators. Okay, I already told you this, and you just can have a look at it. Investors, what do they look at? They look at what is the profitability of the company and how risky is their money in the hands of these people. Now, creditors, what do they look at? When they are advancing or supplying any material, they would look at the credit worthiness of the company. And what is that? Your ability to pay back for the material that he is supplying to you. Then management, what for they are interested, for future planning and to assess the existing performance, and for future planning, management also may be interested to know the financial accounting information. Then regulators, whether they are complying, just to know whether the company is complying with or not. Maybe the tax authorities, if you look at, to levy tax, to charge the tax on the income you are making or the profit you are making, corporate tax. Parties interested, okay. Now, we'll continue with employees. What are they concerned with? Whether they are going to get the regular salary or not. Whether they are going to get the bonus. Whether they are, whether there is a safety for their job. So, they want to know Therefore, they also are eager to know whether their company is doing well or not. Then suppliers, which are creditors, I told you, suppliers and creditors are interchangeably used. Suppliers, if they are just supplying materials, they may supply the materials for cash. They may supply the materials for credit. If they are supplying material for credit, they are called creditors. Creditors also are suppliers, but they are supplying on credit. Now, customers also would like to know the financial data. Now, company's ability, for example, I have an old vehicle, okay, that's from Ford India Limited. Now, when I came to know that Ford India has closed its operations in India, I was a bit concerned. Why? Because my vehicle has to be serviced regularly. If there's a repair or breakdown, my vehicle has to be checked. If there is no service support given by the company, what do I do? Where do I take this vehicle? Other companies may be new to the methodology of repairing Ford vehicles. So, this is a concern of the customer. How long this company is going to be there in the market, so that my product can be serviced whenever I am in need of. Then tax authorities, I have already explained to you. Then how the financial accounting is related to other disciplines of management or accounting. Let's look into management accounting. Financial accounting data is provided to management. There's something called, you can just look at fourth point, auditing. When somebody begin to turn the first page of the book on auditing, first paragraph starts just like this. Auditing begins where the financial accounting ends. The financial accounting closes its books on the last day. Once that closing books are presented, the auditors would come and assess whether all the records that are submitted are accurate, whether they are complying with the regulations of the country, whether they are following rules and regulations, whether they are following the accounting standards prescribed by that respective country or not. So, all these are checked. That's what called as vouching or auditing. Now, to audit, you need the financial data. Just like that, for management accounting, there are certain topics covered in management accounting, like ratio analysis, comparative analysis, common size analysis, funds flow statement, cash flow statement, make or buy marginal costing. All this data you derive it from, which is processed by the financial accounting. Financial accounting supplies basic information to management accounting to further analyze and interpret to facilitate decision making in terms of finance to the management. So, this is how the financial accounting assists the management accounting. Now, let's look at the basic difference between management decision and financial accounting, management accounting and financial accounting. The basic difference is, in management accounting, or the management accounting provides or facilitates decision making, whereas financial accounting does not facilitate decision making. It is a base, but it does not interpret the figures. The financial accounting can simply say the profit is this or the loss is this, but why the profit increase, what is the meaning of this much profit presented, why the loss sustained by the company, all those interpretations are given by the management accounting. So, when there is an interpretation, only then the decision making is facilitated, which is given by the management accounting, whereas that facility is not available in financial accounting. Now, let us come to the financial management. Now, financial management is, it is studying the liability side of the, analyzing the liability side of the balance sheet. In balance sheet, you have listed on the left hand side in India, on the left hand side all liabilities are listed, on the right hand side all assets are listed. Now, there is no hard and fast rule how you have to list the assets and liabilities. There is no rule that liabilities should be left and assets should be right. In other countries, liabilities are presented on the right side, assets are presented on the left side. So, it is the practice in India. Now, that is what we come across, consistency. It is practice in India that liabilities to be presented on the left side and assets to be on the right side. So, the liability side, you find equity share capital, you find preference share capital, you find debentures, you find bonds and other long term debt, other current liabilities like you have bills payable, creditors, outstanding expenses. Now, if you just keep aside the current liabilities and look at only the long term debt starting from equity capital to the long term loan raised from the financial institutions, how this finance is raised and managed is treated as a separate subject called financial management. Now, for the financial management to develop as a subject, the base is provided, the platform is provided by the financial accounting. You prepare balance sheet, but you do not know what it means. 10 rupees equity share capital or 8% 10-year debentures. You do not know what it means when you have written on the liability side of the balance sheet, but it is in detail explained in the financial management. Now, for the financial management to explain, the base is again your balance sheet, which is provided by the financial accounting data. Now, let us look at the economics, how it is related to economics. Now, basically till 1950s and 40s and 50s and even 60s, the accountancy, the financial management, the management accounting, the financial accounting, all these are part of economics. I will, you will be surprised if I tell you that, there are two experts called Modigliani and Miller. These two guys have got the Nobel Prize in economics. What is the topic? The topic is capital structure theories. The capital structure theory is one of the topics of financial management. Now, capital structure is part of the balance sheet. Now, balance sheet is part of financial accounting. There is a financial accounting, there is a financial management, but look at this. They got the Nobel Prize in economics. In those days, what we understand is everything is one subject called economics. Now, we have, as the transactions are becoming voluminous and issues are plethora, we are developing new subjects, new disciplines. That is how the financial management also is developed, and economics is the basis for financial accounting, management accounting, cost accounting and so forth, cost and management accounting. Right. Now, when you want to understand the market structures, it is the economics which gives the data. Now, financial accounting and law, just as I told you that you have to comply with the law of the land. You cannot just write, there are schedules in preparation of the balance sheet. Which schedule contains what is prescribed by the Ministry of Corporate Affairs, and it is given by the Accounting Standards Board of ICAI, Institute of Chartered Accountants of India. Now, all under Ministry of Corporate Affairs. There is a law enacted in the Parliament and that is executed by the MCA, and that becomes the law, and that is applied in preparation of financial accounting. So, therefore, financial accounting is related to law. Okay, and even while reporting, you had to report according to the norms prescribed by the company, the norms prescribed by the government of India if it is in India. Now, this is all about the financial accounting introduction. Now, I would like to take you to the peep into double entry and bookkeeping system, and we will discuss the double entry and bookkeeping system in detail there. But in these days, when we are talking about the formulation of the rules and regulations, the development of norms, it is all by the financial accounting, which is systematically driven to preparation of financial statements, like how the data is procured. There are lakhs and lakhs of issues gathered, and those lakhs and lakhs of transactions all through the year are funneled down to a point called profit and loss account and also balance sheet. Now, how do you record it? You are recording in one set of record, which is called journal, and after this journal you will record that in another set of records called ledger. From ledger you will prepare summary, that's called trial balance, and from trial balance you prepare another statement called income statement or profit and loss account. Finally, you prepare balance sheet and you say, as on so and so year, this is the balance sheet. As on so and so year, ABC in balance sheet of ABC industry. There is a data gathered. When the data is gathered, you are recording. I am just concluding with the definition. There is a data gathered. You present that in a book called journal, and that is synthesized further and presented in another set of books or book called ledger. From ledger you take the summary, and out of the summary and with additional information you prepare the profit and loss account. From profit and loss account we prepare the balance sheet. So, this is the entire crux of financial accounting. So, financial accounting is the process of recording, classifying, analyzing, summarizing and interpreting the financial results of the organization. This is to facilitate management decision. So, this is the end of financial accounting. We will talk about the dynamics of financial accounting in our next session, double entry system.